I'm going to present 4 macroeconomic observations and then discuss how we're processing potential implications of these, both for our own business and for our clients. So first, and I'm sure everyone on the call or on the webinar has seen this, as you can see, the job market is still positive, but steadily cooling, which is likely lowering some pressure on wages, but keeping, as we saw today, especially consumer spending fairly strong. At the same time, inflation is noticeably declining, still not back to the 2% Fed target, though we received a decent report today also with core inflation declining further to 4.2% year over year. I'll note, though, that there's a lot of evidence that the single biggest source of inflation over the past year and month, which you can see here, is shelter. And we're seeing lots of evidence that shelter inflation potentially peaked months ago, and we're now just dealing with the lag effects. So inflation clearly seems to be moving in the right direction. Still, there is a growing expectation among market participants, experts, and so on, that rates are likely to remain higher. This shows a moderate increase in the tips in July, which stayed steady essentially in August, and it's still not back to the highs that we experienced during the rapid inflation of early 2022, but it's still, as you can see, elevated and has elevated even more over the past couple of months, representing higher for longer inflation. And then finally, you see the higher interest rates, the higher inflation, and therefore interest rate expectation over the past month in this chart on the left, which shows both Treasury rates, but also the yield curve. It also is demonstrating an inverted yield curve, which previously was a perfect recession indicator, or at least I should say historically has been a perfect recession indicator. But at the same time, we're not seeing any increase in the BAA corporate bond and Treasury spread, the spread between corporate bonds and Treasuries, which has also traditionally been a pretty good recession predictor also. So what are we supposed to do with all of this? Positive economic indicators, slowing inflation, higher rate expectations for the long term, mixed recession signals. What does it mean? What are we supposed to do with this? And I think the challenge is that we potentially are seeing relatively even odds of a recession occurring in the near term, or potentially avoiding a recession through a soft landing. What we're processing internally, as well as with our clients, is that both are challenging. But most industry professionals know the recession playbook better than the soft landing, higher for longer playbook. We're used to having low rates eventually bail us out in a relatively quick cycle, at least those that have been in the industry for the past. For less than the past 4 decades. It might make sense, therefore, to ponder and evaluate both scenarios on assets, portfolios, and businesses in order to understand where the pain points are actually going to be, both in a recessionary scenario as well as in a scenario that evaluates higher for longer interest rates, cap rates, and so on.